Tim Rood joins us right now, housing industry iconic player. Tim, first of all, I was likening some of these numbers we got out of Case-Shiller as maybe the final spurt of activity, or at least the heightened activity year over year that now is going to start declining. Not necessarily into a recession or even a crash or any of the stuff like that, but you know, we've been used to these strong double-digit advances year over year, and that's going to start slowing. I don't know if that's a good thing or a bad thing. How do you look at it?
Yeah. Hi, Neil. Thanks. I mean, Kelly nailed it. Quite frankly, I was thinking about just taking my per diem and going home. But to your question, look, it's got to moderate. I mean, it's totally unhealthy to have 40%, appreciation rate over a 2-year period. You compound that with interest rates that are doubled, and it's a recipe, obviously, for slowing, a moderating market, which is what we've all been looking for. I think the irony of some of this is the fact that, Jerome Powell wrote the play, called the play, and then now he's just straight up clotheslining, the housing market and the mortgage market, as they're getting downfield like he didn't anticipate it. And as we mentioned before, it's been an arresting development over, I'd say, May, June. There's so much latency in mortgage data. So you're looking at a lot of April data and March, April, May at the latest. And it really paints a much rosier picture. But you forget that interest rates went up a point and a half in May, June, and that had a terrible impact on affordability. And now you're seeing that last surge of desperate buyers, to your reporter's point, that have been fighting their way for 2 years to get into this market, making one last go of it. But on the other end, all you've got are, sellers that are opportunistic, that are looking to take a last-ditch opportunity to sell at the top or near the top of the market. So those are hardly desperate sellers.
So those sellers who are now, I think 1 out of 4, and that's the latest data that I have, and you might have something more current, who were cutting their asking price. Is that the kind of stuff you look for to see if there's a correction or subsiding in the red-hot housing arena?
Sure. Yeah, no, that's a good one. I'd say, look, if you're looking at the existing home market, first and foremost, you look at supply. And supply is still, although it's a little bit higher, it's still half of what it was in 2020, and it's ramping up over the last month or so. But there was a great study that said, hey, look, if you sold every house that was in inventory at the pace of sales today, you'd have a month's worth of supply. I mean, so it's still pretty frantic in that sense, Neil.
So where are we going here? Because you hear these bidding wars even on rents. I mean, they're not quite the same comparison to the bidding wars we saw on properties and 1 out of 10 who are flipping them fast. I don't know where that compares to the boom we had before the meltdown in housing more than a decade ago. But nothing overly wacky going on here, or is this something we should keep an eye on?
Yeah, no, I think you're going to be moderating. Look, it's doing what it should be doing, which is you saw 20% appreciation rates year over year, looking like 18, looking like 17, and right now we're somewhere around 16% appreciation rates. There's going to be more inventory as the summer goes on, probably into the fall. As a consequence of that, you're going to see more pressure on the top end. So you'll see continuing moderation. 2023, I think you're going to see anywhere from 0 to 5% appreciation rates, just in terms of the median sales prices. And if you look at inflation, that's probably going to be north of 5, somewhere less than 10. That means you've got negative real rates, which is difficult. But I think the point that you guys already pointed out is, as we said before, the rental market's no picnic. So all these people who are making that last push to get into their house, when they finally give up the ghost and say, dang, we gave it our best shot, and they go back to the housing market or the rental market, whew, they got a rude awakening there as well. So I see inventory coming up. I see prices moderating. There's $29 trillion worth of equity in residential markets, so there's certainly a huge cushion. And because the economy is still relatively strong, more importantly, employment markets are still strong, you're not setting ourselves up for anything like we saw in 2008, 2009. So
for home buyers looking around and hopefully, saying, I'm going to wait a little while because I think prices are going to come down, offsetting that, of course, is interest rates and borrowing costs continue to go up. Which one's out in your eye?
Well, look, I look at some of these markets that have seen, inventory jump 50, 100% over the last couple of months. And those are all the hot markets. So if you're looking for, hey, I'm a buyer and I'm looking for where's the best buyer's market, I would go back to these markets that were red hot, that are cooling based on the inventory levels. You've got Austin, you got Las Vegas, you got Phoenix, you got Nashville, things like that. I mean, those are going to be softening sort of markets. But what you're seeing play out, Neil, again, it's much more activity on the high end. So when you see these median home prices that seem to be going through the roof, it really reflects a different composition, whereas much more activity on the high end, much less activity on the $300,000 and below sort of properties. And I think that's going to continue just because those are the markets, the people in the urban manufacturing centers up in the Midwest, they haven't seen the same level of appreciation, and those markets are going to suffer in the long term.
Tim, thank you very much. I think Tim Rood, following all of that, following the housing industry as good as anyone out there, probably one of the best at seeing these trends. And right now, the trend might not be necessarily a home buyer's friend for the time being, but of course, nothing like we had with the last big housing meltdown. Gosh, that was what, 15 years ago? That was then. Very different circumstance now, or so we're told. By the way, we want to keep you up to date at the